everybody. Welcome to chapter 17, which is the easiest chapter in the book. That's the good news. It's also not very long. Homework, as I mentioned in my announcements, homework gets shorter in the last three chapters, about half the size of the regular assignment. So also good news, right? So in this very short video, I'm just going to go over the analyses at the beginning of the chapter because it's all about analysis of financial statements, and most of it, 2/3 of it, is devoted to ratio problems, which we already have done throughout the book in Accounting 101 and also in our Accounting 102. There's a ratio problem, at least one, at the end of every chapter, and almost all of them are reviewed here. Not every single one, but many of them. And there are a few new ones. But they're very easy to follow. The illustrations, the formulas, very easy to follow, just like they are at the end of every chapter. So I'm not going to spend time going over the financial ratios, but I am going to show you the beginning part because it's new, but it's easy. Okay. I also have video 2 examples of what I'm about to talk about. So if you look on page 902 and 903, the beginning of the chapter, and also if you're looking at your slides, slide 17, 5, and 6, you'll see they explain how financial statements are used to analyze a company's performance. And there's 3 main ways. We know the third one, the ratio analysis. And like I said, we've been doing that the whole time. Not new and reviewed here. But the first 2 ways, the first way is horizontal analysis. Horizontal meaning going this way, right? Left to right. It compares the current year's performance to the prior year's performance. For your company against top competitors, your company against the industry average, okay? So we call that vertical analysis. And then the second, horizontal analysis. I'm getting ahead of myself. I do it all the time. The second type of analysis, the second way we analyze the business performance is vertical. I bet you saw that coming. Which is, up and down this way. We take from 2 financial statements, the income statement and the balance sheet. We're going to compare each account on these both statements to what they call a significant item, which is kind of ambiguous. What they mean by a significant item, on the income statement, they're talking about net sales revenue. So that will always be the 100%, the denominator, okay? All the other accounts will become the numerator to it to see the percentage, for instance, of cost of goods sold to net sales, or gross profit, or other expenses, net income, all of these numbers, okay? And I'll refer you to the page where it shows it in 1 minute. On the balance sheet, that significant item would be the total assets. Total assets will be the 100% and always the denominator, and all of the accounts will be the numerator divided against, divided by that total asset figure to get the percentage, okay? When I learned it, we learned it as total assets or total liabilities and owner's equity, which was kind of silly because they're the same number. Total assets equal total liabilities plus owner's equity. So they've kind of shortened it now to just total assets, which is a good thing, less confusing. So the other thing you can use the horizontal and vertical analysis for, just like the ratio analyses, would be for what we call benchmarking. Benchmarking is to compare yourself, your company, to your top competitors, as well as the industry average, to see how you stack up. Okay? It's one thing to see how you compare to yourself in the past. That's very helpful. But almost even more helpful is to see how you're doing against everybody else. Okay? So, where am I? up to 904 and 905. Slides number 17, 9 through 12. Okay, so I wanted to actually show you how to do first the horizontal analysis, which starts on page bottom of 904 to 905. And they do show you the horizontal analysis formula. Step 1 is to get the dollar amount of change between the current year versus the prior year. You just subtract. Supposing the current year is less than the prior year. Say the current year sales were 100,000 and the prior year they were only 90,000. That's a bad example. I wanted to flip it. It'd be a $10,000 change increase. But say it was the other way around. Say the current year was 90,000 in sales and the prior year was 100,000. That's a decrease of 10,000. So to show a decrease, you would just use the brackets, and it would be a percentage decrease rather than increase. And they show this, the step 1 and 2, getting the amount of change and then dividing that change amount into what we call the base year. All the base year means is the earlier year, the prior year, that you're always going to see. In other words, it's going to give you how much percentage did that net sales actually go up or down, or the inventory go up or down, the gross profit go up or down. It's one thing to see the numbers, but when you get this amount of change, you then divide it by the base year to get the percentage of change. And you're going to see it on the income statement for Smart Touch on page 906. And the slide is number 11. Okay? And it shows the percentage of change from 2019 to 2020, the dollar amounts first, increase or decrease. There's only one decrease, and that's in administrative expenses. That went down by 5,000. That's a good thing, right? When expenses decrease and nothing else decreases, that's a very positive thing. So you see all the percentages in the last column, okay? If you're looking at the book on page 906, or if you're looking at the slide at number 17. Also on the next page, 907, they show the horizontal analysis for the balance sheet of Smart Touch Learning. Again, with the current assets listed, the long-term assets, property, plant, and equipment, long-term investments, and then the liabilities and stockholders' equity with the report form like we're used to seeing, and all of the increases and or decreases, and there are some decreases. Cash went down, accrued liabilities. I think those are the only two that went down. Oh no, one more, prepaid expenses. So we see all of the percentages, and notice when it's a negative, when it's gone down, it has the brackets. If you don't put that, they'll mark it wrong in Pearson. And that's how you do it, right? Is you're comparing year to year, both in dollar amount and most importantly in percentage. So I do have one to show you coming up in the next video for both it's more of a trend. I'm getting to that in a minute. It is a trend analysis is a form of horizontal analysis. It's really the same thing, except they pick like 3 to 5 year span and show what the trend is for maybe 2 or 3 accounts or all of them. The trend is right following on 907, and you see it on the top of 908. Again, it's another form of the vertical analysis. So the trend percentage, you can take any year and divide it by the earliest year you're going with. The one I'm going to show you, I think the earliest here is 2016, and we go up to 2019. For a Smart Touch 2016, it's a 5-year one. It's at the top of page 908. 2016 is the base year, the trend that they picked, starting from 2016. You can see they're just showing you net sales revenue. In 2016, of course, that's your 100%. You divide each year into the base year, and you see the percentages going down at first, very slightly to 99.7, and then up to 104, 107.1. It's one decimal point as well, and 114.4 for 2020 of the base. So you could say it's a very favorable trend. So that's horizontal analysis, and trend, which is another form of it. And again, video 1, part 1, I do a trend analysis. In part 2, I do a vertical analysis for a company. We see vertical analysis starting on 909. And again, it shows that relationship of each account on the income statement and balance sheet to that significant item. For the income statement, it's the sales, net sales revenue. For the balance sheet, total assets, as I mentioned before. One thing weird about, I don't know, I probably shouldn't say it's weird, but I think it's weird. It's at the top of 909. They give you the formula for vertical analysis percentage, specific item, which is an account, say like cost of goods sold, over the base amount, which would be net sales revenue on the income statement, okay? And that is going to be 100%. Say you did cost of goods sold, it's 513 over 858 for 2020, or 59.8%. They say in the formula to multiply it by 100, and you might say, well, why would I do that? It's because you get a decimal. When you do it, you would get, rounded, you would get 0.598, probably 59784, you know how that goes. It goes on forever in the calculator. But you would round it to 1 point. If you multiply that decimal by 100%, it changes it into a percentage. But I think most of us can easily just change it into a percentage without multiplying by 100. I really don't get that times 100 thing, but I'm not saying it's a bad idea, it's foolproof. You won't mess up. But if you would see 0.598, I think you'd know that's 59.8%. If you don't like changing decimals into percentages, use the times 100. It works like a charm. But, you know, to me it's silly. That was my good part of math, changing fractions to decimals to percentages. So I don't need to do that times 100. But, you know, again, if that gives you a hard time, by all means keep it in. I think it's an unnecessary step, but that's just me. So you see we have our income statement for Smart Touch with, they give you the 2 years, right? A comparative income statement, and you're doing the vertical analysis. For the income statement, again, net sales is always your denominator. The balance sheet on the next page, 910. Again, if you're looking at slides, that one was number 18, the balance sheet. I'm sorry, I think I messed up. The balance sheet is number 18. 17 is the income statement, the one that's on 909. 910 is the balance sheet, comparative balance sheet, and that's number 18. Got ahead of myself there, which I often do. You can see on this one that you have everything listed for the 2 years, and again, your significant account, always your denominator is going to be your total assets. So a good thing to have a comparative, you can kind of look at both years right on the same page and see how you did. And then look for an industry average. Actually, the one we're going to do in video 2, it's only 1 year, but they also have an industry average. So we can compare this company to what the industry is. I believe it's a retail department store. So we don't have an industry average for Smart Touch, but in the next, one more thing I'm going to tell you about, and this is going to be the last thing. On 9/11, the common size income statement for Smart Touch Learning versus the Learning School. Now, we thought that Smart Touch Learning's, if you read this and looked at all the numbers, it looks fairly good. 2020 was better than 2019. You're saying, well, this is great news for Smart Touch Learning, until you look at the competitor who's like, killing them basically in almost every area, unfortunately. Well, the Learning School, and this is what's so good about Common Size. What Common Size income statements do, and Common Size financial statements of any type, they eliminate the size problem. There's no numbers on them, only percentages. If you look on page 911, okay, and if you're looking at your slides, it's 19 and 20, 17, 19, and 17, 20. It's reporting only the percentages. In other words, it's taking those percentages that you saw on, this is income statement, the percentages we just got on the page before on the income statement, putting them just as standalone numbers. This means, like, I have a very small business, family owned, happens to be auto parts. I can take my financial statements that I created and compare them using Common Size to the biggest auto parts, AutoZone, O'Reilly, Pep Boys, Advance, all the multinational chains, billions and billions of dollars of sales, and I'm just a little guy. And that's what Common Size allows you to do. Because numbers, you would look at my measly numbers compared to theirs and think, oh God, they're not stacking up. But when I do it by percentages, we are. So it allows kind of the David and Goliath thing. If that you can slay the dragon, or you can at least keep up with you can run with them. Because it's just showing percentages of increases and decreases, and how your gross profit and net profit come out, how your debt to equity or debt to assets come out, like we do in the trends and we do in the vertical analysis. So it's a very useful tool, this Common Size format, and there's no numbers on it, but extremely helpful. Here's a pie chart on 912. I know I promised you it was the last thing, almost. I mentioned the benchmarking is when you compare yourself to others in your industry and also to the industry average. The last thing, before we get to the ratios, and again, all review, I'm not going to go through them again, very well illustrated. If you need to go back and refresh yourself to examples for homework, they're very clearly illustrated with the formulas in the rest of the chapter. But the last thing I thought was a nice graphic pie chart on 912 showing Smart Touch Learning versus the Learning School. And it's because of the color pie chart and the percentages, you can really see how the Learning School is just beating the heck out of Smart Touch Learning. Cost of goods sold is much lower. Smart Touch Learning, it's 59.8. Learning School, it's only 36.3. Okay, net income 23.5. Smart Touch Learning 5.6. I mean, they're killing them. It's terrible. So it's in every area. They're just, even though when we just looked at Smart Touch for 2 years, we were like, oh, if we were the CEO of Smart Touch, or even a manager or an employee or an investor, we would think it's the greatest thing in the world, until we looked at their top competitor, which is Learning School. Doesn't look so good anymore, right? Okay, again, can check out examples if you need to refresh, and I'm sure you will. Who remembers formulas? I don't. So check them out as you need to in the rest of the chapter, and I'll see you guys in the next video where I'll give examples of what I've been talking about. See you in a few minutes. Bye-bye.